ASTER Decentralized Exchange is offering crypto and tokenized stock trading with perpetuals, spot, limit and market orders, and multi-chain support. Its community-focused tokenomics, innovative airdrop design, and rapid adoption momentum suggest it could scale into a major DeFi player. However, execution risk, competition, and regulatory uncertainty remain significant. The decentralized trading sector is evolving at lightning speed. On one side, we have Hyperliquid, already generating over $1 billion in revenue and dominating on-chain perpetual trading. On the other side, ASTER DEX has entered the scene with explosive growth and a radically different tokenomics model, allocating more than half of its supply directly to the community through gamified airdrops. Add players like Gains Network, gTrade, which blends crypto and stock trading, and you can see a fierce competition forming in one of the fastest-growing corners of DeFi, decentralized derivatives and tokenized asset trading. Fundamental analysis. We will evaluate ASTER Tokenomics, revenue models. We will also compare ASTER with Web3 competitors like Gain Network that also offers crypto and stocks trading at decentralized exchange, and Hyperliquid, the very famous and widely adopted perpetual DEX trading platform. Tokenomics. ASTER's tokenomics are unusually community-heavy, with 54% of supply allocated to the community through airdrops, incentives, and liquidity rewards. This contrasts sharply with many DeFi projects where insiders and venture funds control 20 to 40% of supply, creating heavy sell pressure. ASTER's founders hold only 5%, which demonstrates two important points. Token unlocks are spread over a long time horizon, smoothing supply and mitigating immediate dilution risks. That said, the heavy airdrop-driven issuance does mean circulating supply will expand steadily, requiring matching demand growth to prevent price suppression. Projects like Gains Network faced similar pressure early on but overcame it with strong adoption. Without the 54% community allocation, ASTER would be in a much riskier position. The large airdrop share isn't just marketing. It builds trader loyalty, fuels early liquidity, and signals founder alignment since the team only holds about 5%. Without it, ASTER would look insider-heavy, making users skeptical and limiting adoption, much like many failed DEX launches. The trade-off is that heavy airdrop unlocks create dilution risk, but this is far less damaging than lacking community trust. In short, the 54% allocation is what gives ASTER legitimacy and momentum. Without it, the project would struggle to gain traction against competitors like Hyperliquid. Revenue model. Like other decentralized exchanges, ASTER's primary revenue source is trading fees. This includes spot trading fees, crypto and tokenized stocks, perpetual futures fees, a core driver of DEX revenues globally, liquidation and funding rate spreads on perpetuals, cross-chain bridging and network fees, minor but growing revenue source. This is innovative compared to Hyperliquid, which drives adoption primarily through superior execution and liquidity, and Gains Network, which incentivizes traders via rewards but without a direct conversion loop. Sector benchmarks. Hyperliquid currently the undisputed leader in on-chain perpetuals, capturing a majority of decentralized derivatives volume. Its scale advantage is enormous, making it the benchmark for liquidity and execution. Gains Network, gTrade focuses on crypto plus stock trading with decentralized leverage. Market cap hovers around $61 million. gTrade proved that hybrid crypto stock DEX demand exists, but its chain support is narrower than ASTER's. ASTER DEX. Post-launch, ASTER tokens surged 700% in 48 hours, pushing FDV upward disproportionately to current trading volume. This suggests valuation is stretched in the short term, but comparable projects like Gains Network also started at inflated multiples initially. Founders' allocation in tokens. Founder ownership at 5% is very low, reducing sell-off risk and demonstrating strong community-first alignment. There is currently no evidence of insider selling, which supports credibility. Valuation metrics versus sector. Hyperliquid has already proven how powerful decentralized exchanges can be. It generates more than $1.1 billion in revenue per year just from trading fees, making it one of the most profitable projects in all of crypto. That's the benchmark for ASTER. Now looking at ASTER, Its current circulating supply is about 1.65 billion tokens out of a total of 8 billion. At today's prices, that puts Aster's market cap at just over $1 billion. If you include all the tokens that will unlock in the future, the fully diluted valuation is around $5 billion. This is where token unlocks become important. Right now, the circulating supply is relatively small, but as more tokens get released, the supply grows. If demand doesn't keep up, the price per token can fall even if the market cap grows. For example, if all 8 billion tokens are circulating, the price per token will naturally be lower compared to when only 1.65 billion are circulating. Now let's compare with Hyperliquid. This market cap is over $15 billion. If Aster ever reached that level, the token price would depend on supply. With today's supply of 1.65 B tokens, that would mean a price close to $9.10 per Aster. But if the full 8 B tokens are unlocked, the price would be closer to $2 per Aster. So the unlock schedule really matters. Looking ahead, in a 3-month bull run scenario, if momentum continues with big exchange listings and trading volume growth, Aster could realistically reach a market cap of $3 to $5 billion, which would put the token somewhere in the $2-3 range based on current circulating supply. Over the long term, if Aster executes well and captures market share like Hyperliquid, its price could go much higher, in the $8-12 range with today's supply, or more modest at $2, for once most of the supply is circulating. In short, Aster has strong upside potential, but how high the token price goes depends on adoption. Sector and macro view. Decentralized derivatives and tokenized asset trading are among the fastest-growing DeFi verticals. Gains Network and Hyperliquid have proven demand for perpetuals and stock tokenization. Synthetix has already been in the field for tokenization of U.S. stocks trading in decentralized exchanges since 2021. Decentralized derivatives and tokenized asset trading sit at the intersection of two of DeFi's fastest-growing trends: on-chain leverage/perpetual markets and tokenized real-world assets, RWAs. These markets scale because they combine high-frequency retail trading demand, leveraged short-term flows, with institutional interest in programmable access to traditional assets, stocks, ETFs, bonds, that can be settled and composed on-chain. Perpetuals deliver stickiness through funding rates and liquidations, which create recurring fee streams. Tokenized stocks broaden the addressable market by making equities tradable 24/7 and programmable within DeFi strategies. Infrastructure improvements, better cross-chain bridges, faster settlement layers, and on-chain oracles have materially reduced frictions, letting new DEXs launch with multi-chain liquidity from day one. At the same time, revenue capture models have tightened. Leading DEXs keep a large share of fees and recycle part of revenue into liquidity incentives, creating a flywheel where more volume funds better execution and deeper order books. But this growth competes with increasing regulatory attention on tokenized securities and margin or leverage products, which shapes product design, custody, KYC optionality, and how tokenized stocks are structured. In short, the sector's upside is large, driven by retail leverage and institutional RWA demand, but the winners will be those that combine superior execution and liquidity with tokenomics and governance that survive regulatory and market cycles. Tokenomics comparison and gamified distribution. Aster's tokenomics are intentionally community-centric and innovative. Roughly 54% of supply is reserved for the community via airdrops, rewards, and gamified mechanisms, GEMs or APX to Aster token conversion models, with founders holding a modest 5%. That design flips the traditional insider-heavy allocation model and aims to buy distribution and stickiness through broad ownership. The gamification component, rewarding early users with collectible GEMs or APX units that convert into Aster, does two practical things. It lowers acquisition friction by giving rewards that vest into protocol tokens, and it increases retention because users must stay active to maximize conversion value. This approach can bootstrap network effects quickly, but its long-term sustainability hinges on matching token emissions with growing, recurring fee revenue. Otherwise, token velocity and selling pressure from converted rewards will outpace demand. Hyperliquid's edge is product and volume rather than aggressive user giveaways. It has achieved extremely high revenue per user and per employee by capturing perp volume and optimizing fee capture. Historically, Hyperliquid has prioritized execution, low latency, and professional trader features to build repeatable revenue. If and when Hyperliquid tokenizes or launches a native token-like mechanism, we would typically expect more conservative allocations and vesting that reflect its revenue-first playbook. Gains Network, gTrade, sits between these two models. It has demonstrated that hybrid crypto plus stock perpetual demand exists and has used aggressive incentives historically to grow liquidity and user counts, but its tokenomics have included larger allocations to ecosystem and rewards that created early selling pressure until volumes matured. How the Gamified airdrop model affects sustainability. Aster's Gamified airdrop system accelerates adoption faster than pure fee incentives alone, but it trades immediate growth for longer-term risk if conversion mechanics release a large quantity of tradable tokens quickly. The sustainable path requires a three-leg balance. 1. A decelerating, predictable unlock schedule so that future supply growth is visible to markets. 2. Parallel growth in fee revenue so that rewards are effectively paid by users rather than by perpetual dilution. And 3. Mechanisms that convert short-term reward receivers into long-term platform participants. Staking locks, vesting on converted tokens, or utility that requires holding. If Aster executes on those levers, the community allocation becomes a durable moat. If it fails, token velocity will keep prices volatile and compress real holder returns. Long-run ins and outs for the three major players. Aster's long-run strengths are its community-heavy distribution, multi-chain architecture, and the unique product mix of crypto plus tokenized stocks with perpetuals and spot. These features position it to capture cross-sectional demand, retail traders, tokenized equity seekers, and multi-chain liquidity providers. Its primary outs are execution risk, can it match Hyperliquid's liquidity and slippage profile, dilution risk from future unlocks, and regulatory complexity from tokenized stocks and perpetuals. If founders maintain disciplined vesting and the team converts early users into sticky revenue generators, Aster's community allocation can become a compounding advantage. Hyperliquid's ins are deep liquidity, an established trader base, operational efficiency, and demonstrable revenue generation, all of which are very hard to displace. Gains Network, gTrade, has proven product-market fit for hybrid trading and has historically used incentives to bootstrap volumes. Its ins are first-mover advantages in the crypto stock niche and a playbook for rapid liquidity growth. Its outs are narrower chain support historically, limiting some user flows, and the risk that incentive-heavy growth leaves it exposed to token sell pressure if revenue doesn't catch up. Over the long run, the deciding variables are simple and cumulative. Liquidity depth and execution quality, low slippage, tight funding spreads, sustainable fee capture that can fund incentives without perpetual dilution, regulatory posture, and how tokenized stocks are structured, and governance and founder incentives that align to long-term product build rather than short-term sell-offs. Aster's tokenomics and gamified airdrops give it a powerful early acceleration tool, but converting that early distribution into durable revenue and liquidity is the bridge it must cross. Hyperliquid's revenue advantage gives it defensive strength, while Gains Network's hybrid approach shows there is real demand for tokenized stock/perp hybrids. Each can win in different scenarios. Hyperliquid in pure perp dominance, Gains Network in hybrid niche leadership, and Aster if it successfully turns community ownership and multi-chain product breadth into a sticky, revenue-generating ecosystem. Catalyst Watch, continuation of early airdrop programs, liquidity growth milestones, daily trading volume. Launch of new tokenized stock markets like nuclear stocks are trending now. Gains or Aster can grab market share if they add more stocks at their platform. Expansion into additional chains and integration with institutional liquidity. Sustained adoption of airdrop to token conversion model. Key insights. Community-first tokenomics, 54% allocation, creates sticky user base. Innovative product set, crypto plus tokenized stocks, perpetuals, multi-chain, offers unique market positioning. Strong early momentum with 700% token surge post-launch. Risks include execution versus Hyperliquid. Aster token unlock dilution. Backed by credible ecosystem affiliation, YZI Labs, supporting long-term reputation. In the end, the long-term winners in this sector will be determined by a mix of execution quality, liquidity depth, and sustainable tokenomics. Hyperliquid currently sets the benchmark with unmatched revenue and adoption, but Aster's community-driven design and multi-chain, crypto plus stocks approach give it a unique edge if it can convert early hype into lasting growth. Gains Network has already proven that hybrid demand exists, yet the battle for dominance is far from settled. For investors and traders alike, the next 12 to 18 months will be critical, because the protocols that emerge as leaders now could define the future of decentralized trading for the rest of the decade. If you found this breakdown on Aster DEX helpful, make sure to hit that like button so more people can see it. And don't forget to subscribe. I'll be covering the latest in DeFi, tokenomics, and hidden gems, so you don't miss the next 100x opportunity.